Hello, everyone. Thank you for joining us today for Feeling Insecure about Secure 2.0, a discussion for retirement plan sponsors. Our goal for this next hour is to provide you with a high-level overview of some key Secure 2.0 provisions and things to consider for your retirement plans related to these new rules. So to get started, my name is Kathleen Bardunias, and I'm an of counsel in our Employee Benefits and Executive Compensation Group. And I'm joined today for the presentation by my colleagues Lee Riley, who is a partner in our Employee Benefits and Executive Compensation Group, and Kelsey O'Gorman, a senior counsel in our group. We are all located in Foley's Milwaukee office, and our contact information is included on this slide for your reference. We hope you find today's presentation informative and interesting. And now I will turn things over to Lee to kick off the discussion.
Thanks, Kathleen. We're going to start off with a discussion about the changes that Secure 2.0 made to the required minimum distribution age, which I will refer to as the RMD age. So for context, all retirement plans, and this includes all defined contribution plans like 401ks and 403bs, all pension plans, and all 457b plans are required to commence distributions by April 1, following the year in which the employee terminates employment or reaches their RMD age, whichever is later. So this means that even if the participant hasn't filled out their paperwork to start their benefits, the plan must mandatorily start the payments at that time. Note that if you have 5% owners of the employer that are participating in the plan, they have to start their minimum required distributions at their RMD age, even if they're still working. The RMD age is also relevant to surviving spouses because if a participant dies before they've started to commence their payments, spouses can delay receiving their death benefits until December 31 of the year in which the participant would have reached their RMD age. Plans are not only required to comply with these rules in operation, but they also must make sure their plan document includes provisions reflecting these rules. And then there's a couple of additional items to keep in mind about the RMD age. First, if the employer's spouse doesn't timely start their RMD payments, they're subject to an excise tax on the amounts that should have been paid. And then RMDs are not eligible for rollover. So this slide shows you how the RMD age has changed and is changing in the future. For many years, the RMD age was 70 and a half. Then when the original Secure Act was passed back in 2019, it changed the RMD age to 72, and that was in 2020. That was pretty short-lived because then Secure 2.0 came along and changed the RMD age to 73 starting this year. And then it will go to 75 starting in 2033. It's not clear why Congress skipped age 74, but they did do that purposefully. This is not an error in the chart. But note that even though Secure 2.0 changed the RMD age to 73 starting this year, that's not really accurate from a practical perspective because anybody turning 73 this year was 72 last year. And they've started their RMDs already. So in practice, in actuality, it's the group of participants who are turning age 73 next year that is really the first group who the age 73 RMD age will apply to. In any event, I personally find all these effective dates confusing. So the way I've laid it out on the chart on the slide, I find the most helpful because it's certainly as far as communicating to participants, because everybody can just figure out their birth date, of course, and then they know what their RMD age is going to be. So we've had clients ask us, well, do we have to change our plan to reflect these rules? And I've certainly seen emails from plan record keepers telling clients that, yes, you've got to update your plan for this. And that's not really accurate. Recall that I said plans are required to commence payments no later than the RMD age. So you can always mandatorily commence payments before then. So for example, if your plan says right now, we will start your payments by April 1 after you're 70 and a half, you could leave that provision alone. That is perfectly fine and complies with the law. Now, for most 401k, 403b, and 457 plans, this may not make a lot of sense. So modifying your plan to reflect these new ages has a lot of benefits. It gives you more time to locate missing participants. Your terms of your plan will match what your employees are reading on the IRS website about when RMDs are required to begin, and it will match what their financial advisors are telling them. So your plan will kind of be in sync with the rest of the law and how everybody is thinking about these. But for pension plans, it is a bit more complex. And that's because pension plans have to start providing actuarially increased benefits by April 1 after 70 and a half for people who are still working. And for whatever reason, Congress did not change that rule. So it is still the law that actuarially increased benefits have to start at 70 and a half. So if you change your pension plan and say benefits don't have to commence until 72 or 73 or 75, then you are causing your pension plan to pay higher benefits than if you left it at 70 and a half. Finally, if you have a plan that says if you're still employed and you're 70 and a half, you can come in and start your benefits if you want. So like an in-service distribution. One of the questions is, well, can I change that? Can I delay that in-service distribution to 72 or 73 or 75? We don't have guidance on that yet, so it's not clear. So until we get guidance, I would leave that provision alone because otherwise it might be considered a cutback. And before we leave this topic, there are a couple other changes that Secure 2.0 made to the RMD rules that you should be aware of. First, and this is a big one, no RMDs have to be paid from Roth accounts in a 401k or 403b plan starting next year. So historically, Roth accounts had to pay RMDs just like all other accounts in those plans, but next year that is no longer the case. Now, if somebody has an RMD event in 2023, they still have to take their first RMD by April 1 of next year. So that April 1 of next year is going to be the last RMD that has to be made from a Roth account. And this includes, by the way, people who have been receiving RMDs for years. In 2024, they just don't have to take another one. And so there might be a participant communication. You're going to need to provide those people because that money may not be automatically kicked out to them any longer. And by the way, the reason Congress made this change is because Roth IRAs have not had the requirement to make the minimum required distributions. And so Congress wanted Roth accounts in 401k and 403b plans to match up with what is happening with the Roth IRAs. And then finally, that excise tax that I mentioned, that would apply if people don't get their RMDs on time. That tax went from 50% to 25%, and it can go to as low as 10% if the individual gets all of their back due RMDs completed within 2 years.
Our next topic relates to a mandatory Secure 2.0 change that affects eligibility rules for defined contribution plans, changes to the rules for long-term part-time employees. I will preface this part of the discussion by saying that if your 401k plan does not currently specifically exclude part-time employees, or you have any other hours of service requirements for an employee to be eligible to make deferral contributions to your plan, this long-term part-time employee rule will not have any real practical effect on your current plan rules. So for those of you in that boat, you have a couple of minutes to maybe take a breather, do a quick check of your email inbox. If your 401k plan does require employees to meet certain service requirements before they can participate in your plan, you should be aware of this rule and the recent Secure 2.0 change to the rule. As background on this issue, 401k plans are generally allowed to exclude part-time employees as a categorical exclusion from the plan as long as any part-time employee who earns at least 1,000 hours of service in a year is allowed to participate in the plan after they meet that service requirement. Note 401k plans can, and many do at this point, use more lenient eligibility rules for a variety of reasons. So for example, employees are immediately eligible upon hire to participate in the plan, or 30 days after a full-time or part-time employee is hired to be eligible to participate in the plan. But the maximum service requirement that can generally be applied to the plan's eligibility rules is this 1,000 hours in a year rule. As a refresher, Secure 1.0, the original Secure Act, created this new rule requiring 401k plans to allow all long-term part-time employees to participate in an employer's 401k plan to make elective deferral contributions. Under Secure 1.0, a long-term part-time employee is considered any employee who earns at least 500 hours of service for 3 consecutive years. So the upcoming 2024 plan year is the first year that a plan must allow any part-time employees who earn 500 or more hours of service in each of 2021, 2022, and 2023 to participate in the plan. So if your plan is impacted by this rule from Secure 1.0, hopefully you've been coordinating with your record keepers to track the hours for your long-term part-time employees since January 2021, so that your plan is ready to enroll those long-term part-time employees as of January of next year. Note that the rule only requires long-term part-time employees to be eligible to make deferral contributions to the plan. The plan can still exclude these individuals from receiving employer contributions, like an employer matching contribution that other participants who make elective deferrals to the plan would receive. Secure 2.0 now relaxed this definition even further for who's considered a long-term part-time employee. Beginning in 2025, a long-term part-time employee now only needs 2 consecutive years with 500 or more hours of service. So for your plans, then, part-time employees with 500 or more hours of service in both 2023 and 2024 will need to become eligible to make deferrals under the plan as of January 1, 2025. So as a quick note on the bottom of the slide, while I just explained what the rule requires, in practice, we have seen some plan sponsors consider with these rules simply removing part-time employee exclusions or 1,000-hour service requirements for deferral eligibility rules entirely from the plan when it makes sense, so that employers and record keepers don't need to track long-term part-time employees under the plan. This could be difficult to adequately track within the company's systems, or how to track and report these particular groups of individuals into the record keeper systems. Another place where the rule may create headaches in the actual implementation of the rule is while the rules allow a plan to exclude long-term part-time employees from receiving those employer contributions, the practical issues configuring back-end systems to distinguish this group of individuals from other participants for calculating and contributing an employer matching contribution has caused some employers to simply relook at this issue and consider providing that same employer matching contribution to long-term part-time employees as other employees are receiving under the plan. If the percentage of your population that may get picked up under these long-term part-time employee rules is relatively small, it may be worth considering this opportunity to revisit your eligibility rules under the plan and see if it makes sense to change these rules or update them in some way, rather than having to continue tracking long-term part-time employees going forward and distinguishing these groups for purposes of deferral eligibility and employer contribution eligibility. Otherwise, all plans should be prepared to enroll these long-term part-time employees and notify them of their eligibility to make deferrals in the plan beginning in 2024.
All right, next we're going to talk about the new student loan matching contribution option. So this is the first of many completely optional design provisions that we're going to discuss today that you can, but are not required to implement. So what the student loan match provision does is it allows employers to treat a plan participant's repayment on their qualified student loans as though they were elective deferrals that were made to the plan for purposes of matching contributions. So if an employee made $10,000 of total repayments on their student loans during the year, then you could give them a match on that $10,000, even though they did not actually contribute any of that money to the plan. And so if you're wondering, well, how are we supposed to know how much an employee repaid on their loans during the year? The answer is that the rule permits employees to self-certify the amount of repayments that they made during the year, similar to how they self-certify when they take a hardship withdrawal. If you do decide to implement this feature, something to note is that you must generally treat the match on the student loan repayments the same as the match on regular employee contributions to the plan, meaning that the student loan match has to be subject to the same eligibility criteria, the matching contribution rate, and the vesting schedule as the regular match. However, there is one difference that is allowed. You're allowed to make your student loan matching contributions less frequently than your regular match, as long as you at least make these student loan match contributions once per year. So for example, if your plan does a per pay period match for your regular employee contributions, then you could still be allowed to make the student loan matching contributions on an annual basis at the end of the year. You wouldn't have to continue to make them each pay period, which might create some significant administrative burdens. You are permitted to adopt this feature as early as January 1, 2024. That said, for as much buzz as this new provision received, and there was a lot of buzz about this, I think right when Secure 2.0 came out, we've had very few clients actually want to implement this feature, at least for 2024. We're still waiting on regulations to come out about this provision. And I think people just need a little bit more time to digest it, looking at what is permitted under the rule versus what they actually want to offer. So for the time being, we're not really seeing an eagerness to adopt this new option. So if you don't plan to adopt this provision by next year, then you are certainly not alone.
All right, so now let's turn to several new in-service distribution options that Secure 2.0 added, all for 2024. And these are options you could put in your 401k or 403b plans. But note that if you do choose to implement any of these, you cannot then kind of yank them out of the plan because that would be considered a cutback. So the first new option is called a domestic abuse withdrawal right. And the intent is to give victims of domestic abuse access to funds to help them escape their situation, pay lawyers' fees, or other similar expenses. The participant only needs to self-certify that they have been the victim of domestic abuse by either their spouse or domestic partner within the prior 12 months. And domestic abuse can also include abuse of children or other family members. The participant can receive up to $10,000 or 50% of their vested balance, whichever is less. Note that if you have money purchase pension plan accounts in your 401k or 403b plans, and you know you've got those because those are the horrible accounts that require you to have annuity forms of payments, this withdrawal feature can't apply to that particular account. The second new option is called the emergency withdrawal option. And this is a much more lenient standard than the hardship withdrawals that you're probably all familiar with. To get this distribution, the participant just has to self-certify that they've had a personal or family emergency. They can receive up to $1,000 from their accounts, but only if there will be at least $8,000 remaining after taking that withdrawal. So for example, if a participant has a $1,500 vested balance, they could only get $500 out as an emergency withdrawal because we got to make sure that there's still $1,000 remaining in the account. This distribution is limited to once per year. And then there's a 3 calendar year waiting period before the person can get another emergency withdrawal, unless they contribute the withdrawn amount, through additional participant contributions. So they have to basically pay back the plan in order to get that 3-year waiting period waived. The final withdrawal option is a disaster recovery withdrawal. So under this one, if a participant lives in a federal disaster area and they, again, self-certify that they've suffered an economic loss due to the disaster, they can withdraw up to $22,000, but they have to make that withdrawal within 180 days of the date of the disaster or the date that FEMA declares that there was a disaster in that area. So all three of these have a uniform set of rules. None of these types of withdrawals can be rolled over. If the participant is under 59 and a half, the 10% early withdrawal penalty tax that normally applies is waived. The individual can repay the distribution within 3 years, either back to the plan or to an IRA that accepts rollovers. What we don't know right now is if you choose to offer one of these withdrawal features, do you have to allow the repayments back into your plan? Unfortunately, we don't know because we don't really have guidance yet. My gut is that's probably going to be a requirement, but not sure. And then the one issue that really gives me pause is that all the limits I talked about apply across all plans, plans within a single control group. So as an example, let's say you've got a 401k plan for non-union employees, and then you have a 401k plan for union employees, and you have an employee that's got a balance in each plan because they were union for a while, and then they became non-union. So if that person wants that, say, $1,000 emergency withdrawal, that $1,000 limit applies across both plans, and the once per year limit applies across both plans. So that person couldn't get $1,000 from each plan, as an example. So this is true, again, whether you have union and non-union, whether you have multiple subsidiary companies that have different 401k plans. If you've got employees that might have balances across multiple plans, you've got to figure out how to coordinate all those limits, $22,000 limit, everything I talked about across all of the plans, which can be really difficult if you have multiple record keepers. Kelsey mentioned that for the student match, she hasn't had a lot of client interest in that yet. Same thing on these. I have not had a client come to me and say, boy, I really want to add one of these. And again, it might be because the record keepers maybe are not quite ready to implement these since we don't have regulations. I want to note, for those of you that added qualified adoption or birth withdrawals, back when Secure 1.0 permitted those, that Secure 2.0 has added that same 3-year deadline for repayments to those withdrawals. So again, qualified adoption and birth withdrawals were allowed, I believe, starting in 2020. Similar provision, if a participant took one of these withdrawals, they could repay it back to the plan, but originally there was no deadline about when that repayment could be made. Secure 2.0 has said those also have a 3-year repayment deadline. So now you see that these are all starting to be in sync with each other. Now, the final change that Secure 2.0 made with respect to distributions is interesting because it's the terminal illness withdrawal, but it's different than the ones I previously discussed because Secure 2.0 did not specifically say that this is a new type of in-service withdrawal event. Rather, the main point of this seems to have been that if somebody is diagnosed with a terminal illness and they provide proof of that to their plan, then at the time they get the distribution, they don't have to be subject to the 10% early penalty tax if they're not yet 59 and a half. It's not clear why Congress didn't say that this is a new in-service distribution rate you could add to your plan. It's not clear whether it was an error and they meant to do that. They just didn't put in the right words. Or is it because they thought that this was already covered under existing law? For example, employee deferrals can be withdrawn in the event of a disability. disability doesn't necessarily mean that, you've got a terminal illness, but maybe Congress thought that disability withdrawals would cover it. And then employer contributions can be withdrawn due to illness. That is a rule that's been in the law for decades and that frankly, nobody is really aware of or takes advantage of. So if you're interested in this, you probably could allow this as an in-service withdrawal, but check with your record keeper and your ERISA lawyer on that one.
The next few slides are going to provide a high-level quick summary of some other key new rules under Secure 2.0 or some new potential offerings under Secure 2.0 that affect both defined contribution and defined benefit plans. So this first slide, first, Secure 2.0 increased the maximum amount that a 401k plan can apply to the plan's mandatory cash-out provisions. As background, prior to Secure 2.0, a 401k plan could force out, meaning force a lump sum distribution or distribution of a plan account if a terminated participant had an account balance of $5,000 or less. Most plans at this point have taken advantage of this rule to allow the plan to periodically remove small account balances from the plan, either through a lump sum cash distribution for accounts of $1,000 or less, or establishing an automatic IRA rollover process in the plan for accounts valued between $1,000 and $5,000. For distributions in 2024 and later, Secure 2.0 has raised the maximum amount that a plan could apply to these forced cash outs from $5,000 to $7,000. This is an optional provision. Plans do not have to increase that small balance cash out amount and would require a plan amendment to the extent a 401k plan wants to increase the limit. Plan participants would obviously also need to be notified of this change and what will happen to their account balances now with a larger amount when they leave. Increasing these automatic IRA rollover provisions to $7,000 in your plan may help to move a larger number of smaller account balances out of the plan over time for administrative purposes. The second optional change described on this slide is that plan sponsors may implement, and the plan sponsors may implement this at any time, is to limit the number of ongoing participant notices that have to be distributed to anyone who's considered an unenrolled participant. Under current rules, a 401k plan needs to provide various required notices to all participants in the plan, which for these notice rules includes individuals who are eligible to participate in the plan but have not actually enrolled in the plan. Under this new rule, those individuals who elect not to participate in the plan after they have received an initial notice of their eligibility to participate and a copy of the plan's summary plan description are considered these unenrolled participants. In lieu of providing all ongoing participant notices and communications to that group, the plan can now provide that group with a single annual notice that reminds the individual of their right to enroll in the plan and summarizes the key benefits and rights under the plan. For example, what the available employer contributions are under the plan and the vesting rules of the plan. This may be an attractive option to some plan sponsors who are looking to limit costs related to distributing ongoing communications. But you will need to work with your plan record keeper to determine how to track who are unenrolled participants, determine responsibility for preparing this specific annual notice for the unenrolled participant group, and ensuring that this notice is timely distributed on an annual basis. For example, if you already maintain or your plan is a safe harbor plan, you may be able to use the distribution of the annual safe harbor notice for this purpose by adding some additional language within that document to satisfy this annual notice obligation for unenrolled participants. We are anticipating further IRS guidance about these requirements, but this may ultimately be an option for plan sponsors that save some time, save some money related to printing and distribution of ongoing plan notices and communications for those of your employee population who have elected not to participate in the plan currently. The last item on this slide is also another new optional offering that 401k and 403b plans may provide for non-highly compensated employees in your plan. So, and for 2024, that would be employees who earned $150,000 or less in 2023, and that number changes each year and is indexed each year. Congress's goal with this emergency savings account was to provide a way for participants to save for unexpected or emergency expenses so that they are less likely to need to take in service distributions or loans from their 401k retirement accounts and thereby reduce their overall retirement savings long term. Beginning in 2024, 401k plans may establish these emergency savings accounts under the plan, which is a separate kind of sidecar account to the general retirement accounts, where the non-highly compensated employee may contribute up to $25,000 into this account on a Roth after-tax basis. The plan can choose a lower maximum dollar amount for this emergency account. The $2,500 is a maximum threshold, and that threshold will be indexed over time for inflation. In addition, employers may set up the savings account so that eligible employees need to affirmatively elect under the plan to make contributions to that account, or the plan can automatically enroll employees to make contributions to that account at no more than a 3% contribution rate. Once the participant then has contributed the maximum amount, that threshold $2,500 or lower limit set by the plan, then further contributions may be stopped or could continue and be deposited into the participant's after-tax account. If the 401k plan does provide matching contributions generally, then the employer must also match the amounts that are contributed to the savings account at the same matching rate as other employee deferrals under the plan. Those matching contributions would not go into the emergency savings account, but would go into the normal course matching contributions account under the plan. The emergency savings accounts need to be invested in an option that's designed to preserve the principal amount in the account, right? The goal is for this amount to simply be available for individuals in the event of an emergency. So it's not an investment, it's not using the investment options overall of the plan, or that the individual is electing how to invest this money. The emergency account needs to be invested either in cash, some interest-bearing account, or some other investment fund that's designed to preserve the principal value of that account. Employees must be allowed to take withdrawals from the savings account on at least a monthly basis, and the plan can't charge fees on the first 4 withdrawals in any plan year. When the employee terminates employment, the employee may choose to get a distribution of the savings account or transfer the amounts to sort of a regular Roth account under the plan or an IRA. There are still a number of open questions about how to implement these savings accounts, including how to make that non-highly compensated employee determination early enough in the year to determine the group that's eligible to make these savings account contributions for that year. The practical aspects of tracking these contributions and properly stopping savings account contributions when they've hit the maximum threshold, and or restarting contributions after a withdrawal is made. And then how these contributions may affect the plan's general non-discrimination testing. We are waiting for additional guidance from the IRS here, but as that comes in and as record keepers develop back-end systems to administer these types of accounts, you're likely to hear more about their availability as an option for you under the plan. I think the key to making this emergency savings account option really a successful addition under any plan and to be utilized by plans is going to ultimately be the ease with which plan sponsors are able to establish and actually operate these accounts through the plan's record-keeping systems, as well as having a strong communication plan to make sure that participants are actually aware of these accounts. They have simple and clear methods to access the funds, and so that these accounts don't end up in sort of a lost participant type structure, or that they're not being utilized, but creating a lot of headaches from an administration standpoint for the plan.
All right, this slide sort of continues on the last slide, providing 2 more sort of miscellaneous changes in Secure 2.0 for defined contribution plans. So the first one is that it's now permissible to offer small immediate incentives to employees if they decide to participate in the 401k plan. So before Secure 2.0, the rule was that you cannot make the receipt of any benefit other than matching contributions under your plan contingent on an employee deciding to enroll and make contributions to the 401k plan. What Secure 2.0 did is it carved out a small exception to this rule for de minimis benefits. So you can now provide small prizes or other incentives for employees who decide to sign up for the plan. For example, you could say, oh, if you enroll in the plan by this date, then maybe you get a $10 Starbucks gift card or a free lunch or some company swag, small type of benefits like that. So as of now, Congress has not defined what it considers to be de minimis in this context. It's possible that there's going to be more guidance on this when we get regulations. So for now, I would say that smaller is probably better. So if you're thinking about doing this, then just think small. Again, this is optional. You obviously do not have to provide these sort of incentives for people to participate. This is just something you can do if you would like. One potential gotcha that I wanted to mention here is that the small benefit that you are providing as an incentive could still be taxable to the employee. So Congress did not provide an exception to the general fringe benefit taxation rules when they put this rule in place in Secure 2.0. So if the benefit would otherwise be taxable to the employee, if you just gave it to them for any other reason, then it would also still be taxable now. Those regular rules still apply. So just something to keep in mind. The next one is the Roth catch-up contribution rule. And this new rule requires, meaning this one is actually mandatory for all plans, is that any catch-up contributions for participants who make more than a set amount, currently $145,000, but that's indexed to go up every year, they have to be made on a Roth basis. They can no longer be made on a pre-tax basis. This provision was originally supposed to go effective as of January 1 of next year, and it was causing a lot of heartburn, both for plan sponsors and for administrators for a number of reasons. But I think especially for plans that otherwise did not already have a Roth feature. And there were a lot of questions about whether you would have to offer a Roth feature so that people could make catch-up contributions, among other questions about how to go about properly administering this. So to everyone's relief, the IRS came out with guidance this August that effectively delayed this new Roth catch-up requirement until January 1, 2026. They also stated that more guidance is going to be forthcoming. So hopefully that guidance is going to provide a lot more clarity to everybody about how this rule is supposed to be implemented. But at the very least, it's given everybody a lot more time to figure this out. Secure 2.0 also contains some small defined benefit plan changes. Congress really didn't want anyone to miss out on the fun here. So this slide just highlights three changes that are applicable only to defined benefit plans. The first is that there were some revisions to the annual funding notice. Congress said that the goal here was to try and make these funding notices more understandable by the average person and more straightforward. The biggest change is that the measure of how well a plan is funded is now going to be different. It historically was a funding target attainment percentage, but it's moving to a more straightforward ratio of the plan's assets divided by the plan's liabilities. This change is going to first apply for notices that are sent for plan years beginning on or after January 1, 2024. So practically speaking, that is the notices that are due in April of 2025 if you're on a calendar year plan year. The old rule is still going to apply for the funding notices for 2023 that you're going to send in April of next year. So just keep in mind that as you are reviewing these notices, there are going to be differences starting in about a year. The second new rule for defined benefit plans is there is a brand new required lump sum window notice that these plans are going to have to provide at least 90 days in advance if they decide to offer a lump sum window to participants. And really the only thing I wanted to highlight on this one at this time is that this notice is not required until we get final regulations, which we don't have yet, obviously. So I just wanted to bring this to your attention because you might see some articles that mention this one since it's a brand new requirement. But just wanted to assure you that it's not actually required yet. So just something to keep on your radar in the coming years and months. And then the third change for defined benefit plans is that there's also a change to how annual PBGC premiums are calculated for underfunded plans. So for those of you who work with defined benefit plans, you probably know that there are two components to the annual PBGC premium. First, there's a flat per participant premium that all plans have to pay, regardless of funding status. And this one is not changing. This one is going to continue to work as it always has been. It's going to be indexed every year. No change here. The second part of the premium is the variable rate premium, and this one only applies to underfunded plans. This part of the premium is equal to a % of unfunded vested benefits and then subject to a per participant cap. So the % for this variable rate has previously been indexed and it's gone up almost every year. However, under Secure 2.0, it is effectively frozen at 5.2%. Which was the rate for, I believe, last year, unless and until Congress affirmatively changes it again. Note, however, though, that the cap, that per participant cap, is still indexed. I'm not really sure why they decided to freeze that percentage, but not the cap, but that is the rule.
Okay, so now we're going to talk about DC Plan Auto Portability Services. This is a really cool new thing in Secure 2.0 that I think many plan sponsors will take advantage of because it's incredibly helpful to participants, in my opinion. So what this does, what this is trying to deal with are those small account cash outs. So that's the provision maybe you've got in your 401k or 403b plan that if your balance is less than $5,000 and more than $1,000, when you terminate employment, if you don't take action to take that distribution from the plan, we will automatically roll that into an IRA on your behalf. And keep in mind the $5,000 can go up to $7,000 next year. So consider a participant that has had this auto rollover, due to their small balance. So now they've got money sitting in an IRA and they go become employed by a new employer. And they want to get that IRA money into their new employer's plan. So right now there's quite a process that participant has to go through to get that money moved. First, they have to even remember who the IRA custodian is, because remember, this isn't an IRA custodian they picked. This is the one you picked for these rollovers. They then have to contact that IRA custodian, make sure they have the name of the new plan, correctly communicated to the IRA custodian. That IRA then will mail their check to their home address, and then the participant has to get that paper check over to their new employer's plan. So it's a cumbersome process for participants when we're talking about, not a lot of money. So what these auto portability rules do is they cut through all of that procedural mess by automatically moving money from that small balance IRA into the new employer's plan. There are right now a consortium of what I would consider the major, record keepers here in the United States that have joined what's called the Portability Services Network. And so this is a group of record keepers that are going to share information with each other. So they know that, Lee has left her employer, has a rollover IRA, and is now at a new employer because my name, under the new employer's plan gets fed to the record keeper. And they go to another record keeper in the consortium and they're like, hey, do you have a small balance for Lee on your records? So this group of record keepers is joined together. They're going to share information to make all of this happen. And then record keepers who are not part of this network right now are also considering ways to share information to make this happen. And my understanding is that this network is going to go live on January 1, 2024. So this is pretty imminent that this is going to be available. Now, in order for the auto transfer to occur, the participant will get an advance notice, at least 60 days in advance of when the money would move from that IRA to the new employer's plan. And they will notify the participant that, like, hey, this transfer is going to be happening. Here are the fees that will apply, if fees are charged, and that the person can opt out of the transfer if they want. If they don't want this to happen, they can say no. If you choose to implement this for your plan, it's not clear to me right now whether you'll necessarily need to amend your plan document to reflect this. I don't think you're going to have to say anything about rollovers coming out of your plan. You've already got a provision that says if it's a small balance, it goes to an IRA. But the section in your plan talking about rollovers coming into your plan, that might need some tweaking, because your language might say an eligible employee can choose to have money rolled into my plan. And the way this works, it's not really a choice. It's just going to happen automatically unless they opt out. Likewise, for summary plan descriptions, you might want to look at that, because again, your summary plan description might talk about rollovers being money that the employee has chosen to put into your plan, and that's not quite accurate under this new scenario. So I know record keepers are already contacting their clients about this, and I personally think this is really cool and will help participants not lose track of their money and get it all consolidated in one place.
So we've talked today about a lot of changes, some mandatory, some optional. So you might be wondering, when are the plan amendments, to the extent they're required, due? Generally, all the Secure 2.0 amendments for both required and optional changes are due by December 31, 2025. So there's no real rush to get any amendments done before the end of this year or even next year, as there's just plenty of time. As previously mentioned, we're still waiting on regulations, and we also expect that we're going to receive model amendment language for a lot of these provisions. So in most cases, it's probably prudent to try and wait until we receive the model amendments and final regulations whenever possible, to sort of save time and legal fees. However, there are a couple of situations when you may have to amend your plan before the general December 31, 2025 deadline. The first instance is if you're terminating your plan before December 31, 2025. So when you terminate a plan, you have to include all required amendments before the plan is terminated. And so then in that case, your due date for getting all of these amendments done is going to be determined by the date of that plan termination, rather than the general December 31, 2025 date. The second instance is similar to a plan termination, and that's if you're merging the plan into another plan so that it no longer exists as a separate plan. You still have to amend that plan that you're merging for all of these amendments. And you could wait until December 31, 2025 to do that for that merged plan. But it's a little bit awkward, because I think people think of that plan as no longer really existing. You might also just forget because it's not top of anyone's mind anymore. So in that case, you really might want to think about trying to get these amendments done to the best of your ability before you actually merge it into the other plan. The third instance is that, as we discussed today, you can start adopting some of these optional design provisions, like the student loan match or some of the in-service withdrawal options that Lee talked about, starting in 2024. And while you can legally implement these provisions before you formally amend your plan document, your vendor may still want to see an official plan amendment signed before they're willing to implement one of these options for you. So then again, in that case, you might be forced to do the amendment before that December 31, 2025 deadline.
Okay. So the last topic we wanted to briefly cover today are some key updates that Secure 2.0 made to the IRS's correction program for operational failures under defined contribution and pension plans. I'm going to go through these items rather quickly today and really only be covering a very minor portion of the correction program. But the key takeaway, if you don't remember anything else I say over the next few minutes, is that if you have an operational error come up with your plan in the future, which you may likely will at some point in time, don't assume that the way you corrected the issue in the past is the way that you must or even should correct it now, as there may be a simpler or less costly way to correct the issue now with these new Secure 2.0 changes. If you do have an operational error in your plan, I would recommend that you reach out to your ERISA counsel or your plan providers to see if one of these new correction options may be available, even if it's a failure or an error that has occurred previously under your plan. So even the best administered retirement plans experience operational errors, where the plan is administered in a way that it's not in line with the terms of the plan. For example, eligible employees are not timely enrolled in the plan, incorrect contributions are made, or an employer fails to make required contributions based on the terms of the plan, or a plan distributes an incorrect benefit to a plan participant. As a quick reminder and overview, when these things happen, the IRS has developed a correction program, the Employee Plans Compliance Resolution System, or EPCRS, which provides safe harbor guidance for how plans can go about self-correcting these types of failures, or when a plan may need to file a correction approach with the IRS for their approval. Over time, the IRS has been expanding EPCRS more and more to try and encourage retirement plans to proactively audit their plans, correct failures when they're discovered, and Secure 2.0 further expanded some of the corrections available under EPCRS. While these changes are generally effective now, the IRS has not yet updated EPCRS itself with further details, but is required to do so by the end of 2024. One type of error that has been addressed under Secure 2.0 is the recovery of overpayments. So overpayments happen when a retirement plan distributes a benefit to a plan participant that is more than the individual is actually entitled to under the terms of the plan. This issue is more likely to occur in pension plans than in individual account plans, like a 401k plan. For example, a pension plan incorrectly calculates the participant's annuity payments, or continues to pay a surviving spouse a higher survivor benefit than he or she is actually entitled to based on the participant's benefit elections under the plan. Previously, in these circumstances, the plan generally had an obligation to try and recoup the overpayments from the participant or the beneficiary, including by reducing future payments or ultimately contributing those overpayment amounts to the plan trust itself. Now, pension plan administrators have much more discretion to decide whether or not to recoup an overpayment, and the plan administrator choosing not to recoup inadvertent overpayments won't be considered a breach of fiduciary duty to the plan under these rules. Plans may also actually no longer be allowed to recoup plan overpayments in certain circumstances. For example, if the first overpayment actually occurred more than 3 years before the error is being corrected, then the plan can't recoup the payment from the participant unless the overpayment was due to the participant or the beneficiary's act of fraud or misrepresentation to the plan. When a plan does choose to recoup overpayments, there are also some new rules that you will need to be aware of for how and when those amounts can be recovered. For example, a plan is no longer allowed to charge interest on an overpayment. There are certain maximum limits on how much may be able to be recouped from a participant in any 1 year, and the plan may not seek to recoup overpayments made to a participant from the spouse or beneficiary after the participant's death. Given these new rules, if you are maintaining a pension plan in particular, I recommend considering developing a written administrative policy on how the plan will address overpayments to provide guidance and a roadmap to your HR teams and consistency for the plan's overall administration. For example, do you want to treat culpable, which would be involving fraud or misrepresentation from the participant differently than a non-culpable participant when there's an overpayment issue? Will there be a threshold where overpayments under that amount will not be recouped from the plan as a general matter, but at a certain value, the plan fiduciary or your benefits committee will need to review and determine whether or not to actually seek repayment? Are there form notices the plan will use to communicate with participants and beneficiaries about these payments? Any policy should be prepared in consultation with the plan's record keeper and ERISA counsel, and should be reviewed and approved ultimately by the plan administrator. So for example, your benefits committee overseeing plan administration. Another area in EPCRS that was touched by Secure 2.0 relates to the expansion of self-correction programs. EPCRS provides detailed guidance about when a plan can self-correct an operational failure, simply meaning that the plan can just take the necessary actions to correct the issue without having to file a specific filing or request to the IRS for them to approve the correction. Over time, the IRS has been making it easier and easier for plan sponsors to self-correct more errors, really in an effort to encourage plans to be proactive about finding and correcting plan failures when they occur. When a plan completes a self-correction, one thing to keep in mind is that you should always maintain detailed records of the correction, including a summary of the applicable parts of EPCRS and a summary of the actions taken to be able to produce to plan auditors or the IRS in the event of a plan audit. Secure 2.0 further expanded the availability to a plan to use self-correction, which is a benefit to plan sponsors who then don't need to pay to file a VCP application and prepare an application with the IRS as often when there is a plan operational failure. The IRS published some interim guidance this year on the expansion of the self-correction program, which plans may rely on until the IRS formally updates EPCRS. But there are still certain types of operational failures that may not be self-corrected. So it is important to confirm whether or not an IRS filing may still be required or recommended when you are correcting an operational failure. Currently, EPCRS must be updated by the end of 2024, so we will be looking for more detailed guidance from the IRS when that update is released. And the last key change related to automatic enrollment contribution errors. So automatic enrollment errors occur when a 401k plan that automatically enrolls participants into the plan to make a deferrals under the plan unless the participant affirmatively opts out of the plan if they fail to enroll that participant based on the terms of the plan or implement that individual's affirmative election. So say the default percentage was to enroll at 3% and a participant wanted to contribute a different percentage to the plan. EPCRS previously contained some specific safe harbor corrections that were available for these types of errors that allowed the employer to provide less of a corrective contribution than in some other circumstances. These safe harbors were set to sunset at the end of 2023, but Secure 2.0 permanently established this special correction rule. If the plan timely corrects the error, which basically means that you've addressed and corrected the error within 9.5 months after the end of the year in which the error occurred, or by the first day after, on or after the last day of the month in which the employee tells you that you failed or had an enrollment error, if that's earlier, then the employer does not need to provide a corrective contribution related to the affected participant's missed deferrals. And they only need to make a corrective contribution with earnings related to any missed matching contributions that the participant would have received if they had been properly enrolled through the automatic enrollment process. So this is a good opportunity, again, to check if you have an automatic enrollment feature in your plan, these changes, and making sure that you're aware of all your options to actually correct any of these types of failures.
Okay, so I know we're over a little bit. We had 3 questions come in that I think we can deal with pretty quickly. So Mary Lou asked, are plan amendments needed for all of the optional changes? I'll go ahead and answer that one. Yes, Mary Lou, you would need to amend your plan for everything we talked about, regarding plan changes, other than the small incentives and maybe other than that auto portability of those rollovers. Kelsey, this one's for you on the student loan match. Can plan sponsors require proof that the employees actually paid their student loans?
That is a great question and something a number of our clients are also asking. So it's not entirely clear from the Secure 2.0 text. It says that you may accept self-certification. So that suggests that yes, maybe you will be able to somehow require proof. However, Secure 2.0 said that they have to come out with regs that are sort of going to outline what the reasonable procedures are that employers can use to allow employees to claim matching contributions. So I think all anticipate that it won't be mandatory that you use the self-certification, but it's not entirely clear as of yet.
Okay. And then Last one is Mike asked, on the required minimum distributions, is it still okay to delay RMDs until somebody terminates employment? And the answer to that is yes, that is still fine. No change was made in that regard. Because we are over, if any questions come in the meantime, and we will get back to you by email. So I want to say thank you to everybody for participating today. I hope you found this helpful and enjoy the rest of your day.